Hi, dear friends, welcome back to the lecture session on Indian banking system. Today, we are going to discuss the remaining aspects of Indian banking. First of all, let's understand the cooperative banking system in our country. The cooperative banks are classified under three heads. One is the state cooperative banks, urban or central cooperative banks, primary credit societies. State cooperative banks, so they are small financial institutions which are governed by Banking Regulation Act of 1949 and the banking laws, and also the Cooperative Societies Act of 1965. At present, there are about 33 state cooperative banks, of which 19 cooperative banks are scheduled cooperative banks. Second cooperative banks category, urban cooperative banks. So they refer to primary cooperative banks located in urban and semi-urban areas. Till 1996, they were allowed to lend money only for non-agricultural purposes. This distinction does not hold today. So these banks were traditionally centered around communities, localities, workplace groups. They essentially lend to small borrowers and businesses. There are about 2,104 urban cooperative banks, of which 56 were scheduled banks. About 79% of these are located in 5 states, basically Andhra Pradesh, Gujarat, Karnataka, Maharashtra and Tamil Nadu. Third category of cooperative banks, primary credit societies. So the primary credit societies is basic unit and smallest cooperative credit institutions in our country. It works on the grassroots level, especially under Grama Panchayats and village level. It virtually functions like banks, but whose net worth is less than rupees 1 lakh, who are not the members of the payment system and to whom deposit insurance is not extended. Nationalization period 1969 to 1991. In 1969, Government of India nationalized 14 commercial banks in our country, whose national deposits were more than 50 crores. So these are the 14 commercial banks which were nationalized in 1969. Sorry. The Indian banking system immensely developed after the nationalization, but the rural and weaker sections of the society were still not covered under this system. To solve these issues, the Narasimham Committee in 1974 recommended the establishment of regional rural banks. On October 2nd, 1975, so these regional rural banks were established with an objective to extend the amount of credit to the rural area. In 1980, another 6 more commercial banks were nationalized. The target of priority sector lending, it has been raised to 40%. So these are the 6 commercial banks which were nationalized in 1980. So now let's have a glance over the new private sector banks which are being operated in our country. HDFC Bank Limited, IndusInd Bank Limited, UTI Bank Limited, ICICI Banking Corporation Limited, Bank of Punjab Limited, Global Trust Bank Limited, Development Credit Bank Limited, Centurion Bank Limited, Times Bank Limited, IDBI Bank Limited. So list of old private sector banks which can be studied. There are 10. The old private sector banks have been listed in this slide. Bank of Rajasthan Limited, Catholic Syrian Bank Limited, City Union Bank Limited, Dhanlakshmi Bank Limited, Federal Bank Limited, ING Vaishya Bank Limited, Jammu and Kashmir Bank Limited, Karnataka Bank Limited, Karur Vaishya Bank Limited, Lakshmi Vilas Bank Limited. So let's understand the recent development in the bank sector. Kotak Mahindra Bank and Yes Banks, which have got the license from the RBI to entry in the banking sector in 2003 and 2004 respectively. In 2014, RBI grants the principal approval to the IDFC and Bandhan Financial Services to set up the banking system in our country. Today, Indian banking industry is one of the most growing, flourishing industry. Banking system of any country needs to be effective, efficient, as it plays the active role in the process of economic development. So now let's understand the regional rural banks. In 1975, a new set of banks called regional rural banks started under the recommendations of the working group which was headed by Sri Narasimham to serve the rural population in addition to the banking services offered by the cooperative banks and commercial banks in the rural areas. Inception of RRBs can be seen as a unique experiment as well as experience in improving the efficiency of the rural credit delivery mechanism in our country. With joint shareholding by central government, the concerned state government and sponsoring banks, an effort was made to integrate the commercial banking within the broad policy trust. RRBs were expected to play a vital role in mobilizing the savings of the small and marginal farmers, artisans, and agricultural laborers and small entrepreneurs, and inculcate the banking habit among the rural masses. So these institutions were also expected to plug the gap created in extending the credit to the rural society by largely urban oriented commercial banks and the rural cooperative banks which have close contact with the rural areas but fall short in terms of the funds extended to the rural masses. So that is the reason why the regional rural banks were established in the rural areas to provide the credit for the rural masses in the year 1975. The share capital of RRB is contributed by the Government of India and the concerned state and the sponsored public sector banks in the ratio of 50, 15 and 35% respectively. The area of operation of the RRB is limited to that particular district in that particular state. So these banks mobilize the deposits primarily from the rural areas and semi-urban areas and provide loans and advances mostly to the small and marginal farmers, agricultural laborers, rural artisans, and other segments of the priority sector. With a view to providing better customer service in the rural areas, these are convert their satellite services, convert their satellite services offices into the full-fledged branches after obtaining concurrence from their board and necessary license from the concerned regional office of RBI. As a result of the amalgamation, the number of regional rural banks has been reduced from 196 to 82 as on 31st March 2011. The number of RRB branches, regional rural banks branches increased to 16,698 in 2012. So there is another banking system, that is local area banks. So these are started operation in 2 or 3 contiguous districts were conceived in 1996 Union Budget to mobilize the rural savings and make them to available for investment in the rural areas. They are expected to bridge the gaps in the credit availability and enhance the institutional credit framework in the rural and semi-urban areas. Although the geographical area of the operation of such banks is very limited, they are allowed to perform all functions of a scheduled commercial bank. The Raghuram Rajan Committee has envisaged these local area banks as private, well governed, deposit taking small finance banks. They were to have higher capital adequacy norms, a strict prohibition on related party transactions, and lower concentration norms to offset chances of higher risks from being geographically constrained. 6 entities were given the licenses to operate local area banks by Reserve Bank of India, but only 4 are functioning. Of these 4 banks, Capital Local Area Bank accounted for more than 70% of the total assets of 4 local area banks taken together as on 31st March 2012. Local area banks were set up as per a Government of India scheme announced in August 1996. So there are only 4 local area banks in India which exist in the form of non-scheduled banks. So among these 4 non-scheduled banks working as a local area banks, number 1, Coastal Local Area Banks Limited, Capital Local Area Bank Limited, Krishna Bhima Samruddhi Local Area Bank Limited, Subhadra Local Area Bank Limited. So these are the 4 non-scheduled banks which are operated in the local areas, especially in the rural area, as local area banks. So now let us focus on the functions of the commercial banks. The functions of the commercial banks have been classified under 2 heads. One is primary functions and secondary functions. Under the primary functions, we have accepting deposits, lending loans. Under secondary functions, agency functions and general utility services. Let's understand so these functions one by one. Primary functions of a commercial bank: accepting of deposits. Savings deposits encourage customers to save money and to promote the banking habit among the public. Savings bank accounts provide a low rate of interest and they have restrictions on the number of withdrawals by the customers. Savings bank account can be opened in a single or joint names. People who prefer these savings banks account into salary and wage earners. So now, all the banks are allowed customers to open the savings bank account with nil balances. So recently, State Bank of India has allowed the customers to open their account, SB account, with zero balance. Current deposit accounts, which can be opened by the businessman. So these accounts have no restrictions on the number of withdrawals, but are the subjects to service changes. There is no interest payment towards the account holders because they are availed. So number of benefits such as OD facilities, cash credit, etc. Fixed deposit accounts can be opened by any person who wants to deposit in lump sum money at one time for a specific period of time, say 5 years, 10 years, etc. So these accounts provide higher rate of interest depending on the time period for which the money has been deposited. So these accounts do not allow withdrawal before the expiry of the period. So recurring deposit accounts are normally opened and operated by the persons who get regular income such as salary class and petty shop owners. A specific amount of money is deposited periodically, say monthly, for a specific period, say 1 year. So these accounts provide higher rate of interest and do not allow the withdrawal before the expiry of the period. Second important primary functions of the commercial banks are lending, loans and advances. So lending, loans and advances can be studied. Number 1 can be studied under OD. It is a facility extended by the banks to the current account holders who maintain their accounts for business purposes. In this facility, the current account holder can withdraw more money from their accounts than what they have maintained as balance. Under these facilities, banks honor the checks drawn by the customers of the current account holder even if sufficient money is not available in their accounts. So this overdrawing limit will be fixed by the banks for a certain period based on the credit quality, credit worthiness of the current account holder and their history of dealing with the bank. The amount of overdrawn will be considered as a loan and interest will be charged on the actual amount that has been withdrawn by the clients. Another important advance is cash credit. It is a facility extended by the banks to current account holders and others who do not have an account. In this facility, the banks sanction a credit limit to a borrower for a certain period, usually for a longer period than overdraft. After verifying the credit worthiness and history of the client's customers and the track record of the business, normally the banks expect security tangible assets against the cash credit which can be extended to the current account holders. Interest will be charged on the portion of the amount withdrawn from the cash credit account, but not on entire amount sanctioned to the borrower. Another important lending is loans. So loans and advances which are normally sanctioned for a short period, say 1 year, a medium period, say 3 to 5 years. At present, the banks lend money, long-term loans also. Repayment of loan will be made on various installments, say monthly, quarterly, once in 6 months, annually, over a specific period of time. Banks charge interest on the actual amount of loan sanctioned and the rate of interest somewhat lower than what is charged on the OD and cash credit facilities. Regarding collateral security, the banks expect some tangible assets against which the banks are extending the loans. There are various types of loans such as secured loans, mortgage loan, education loan, and personal loans, etc. So these are the different types of loans which are extended by the commercial banks to their customers. For example, a secured loan includes two-wheeler loan to the individuals, working capital loans for the businessmen, mortgage loans are also given to the borrowers to purchase immovable, tangible assets such as land, building, homes, etc., with a lien on the asset which will be serving as collateral. At present, majority of the banks are granting the home loans to their customers. Education loans for higher studies, professional courses are also extended to the students at a reasonable rate of interest. Personal loans, which is also considered as consumer finance for the individuals who are provided on easy terms and conditions to buy customer durables like TV, refrigerators, and other consumer durables. Discounting of bills of exchange is another method of granting loans by the commercial banks, especially to the traders. The banks can advance funds by purchasing or discounting the bills from the traders. So, those bills which arise from the trade. Trade bills are those bills which emerge due to credit sale to customers. If the traders require money before the expiry of the bill, so those people can discount the bills with a bank. The banker will pay an amount to the drawer or beneficiary of the bill after deducting the discount amount. On maturity of the bill, the banker will receive the amount from the drawee of the bill. So this is the way how the banks are extending loans by discounting the bills of exchange, usually the foreign bills. So now let's discuss some of the secondary functions of the commercial banks. Agency functions. Transfer of funds is made by the banks from one branch to another or from one place to another for customers. At present, the banks are using technology and telecommunication system that facilitates these money transfer from one person to another person, from one bank branch to another bank on behalf of the customers. Example, electronic fund transfer. For this service, banks collect service charges from the customers. Collection of checks is facilitated by banks through clearing section. So thus the checks deposited or presented for collection are credited to the customer's account once they collect the same through clearing process. This includes the checks of the same bank or the bank's other banks and within the station or outstation. For providing this service on behalf of the customers, collection of payment for the checks, so they charge collection charges, which is very nominal. Periodic payments such as payment of public utility bills, rent, interest, etc. are made by the banks on behalf of the customers based on their standing instructions. As per the instructions, the tenant, on behalf of the tenant customer, the rent will be paid by the banker. Specific example, payment of housing loan interest from salary account. Fourth, periodic collections such as receipt of salary, pension, dividend, interest, rent, etc., are made by the banks on behalf of the customers based on their standing instructions. A specific example, receipt of dividend from investors. Portfolio management services are offered by the banks to guide the customers or clients on their investment decisions, to buy or sell the securities, to achieve the optimal portfolio for getting maximum returns. So, therefore, they are providing portfolio management services also to the customers. Thus, even they entered into the secondary market. Other agency functions like acting as a trustee, administrator, advisor, executor, etc., on behalf of the customers or clients are provided by the modern commercial banks. So now let's understand some of the general utility services provided by the bank. Issue of draft, traveler's checks, letters of credit by the bank to the customers to transfer the money from one place to another place. Safe deposit lockers also provided to the customers in order to keep their valuables such as documents, gold, diamonds, silver articles, and the valuables. Underwriting of shares and debentures are done by the banks in the capacity of the commercial banker through their subsidiaries. In the case of clients' capital issue fails in the market, the banks assume the risk of under subscription by the underwriting issue. For this, banks receive underwriting commission. Dealing in foreign exchange can be undertaken by the banker as they are allowed by the RBI. So many commercial banks are allowed to have the foreign exchange business. So they will act as deal makers or traders depending upon their position. Project reports are being prepared on behalf of the customers, especially the corporate clients. Many corporates which take up projects and look for financial assistance have to be prepared the project report for submitting the same to the financial institutions or banks. So this project report prepared requires expertise personally which the banker possesses. Banks collect the consultancy charges from their clients by providing project services. Social responsibility programs such as public welfare campaigns, adult literacy programs, maintenance of schools, parks, blood donation camps, etc., are also undertaken by the banks to showcase these social responsibilities. The other utility functions may include any other functions that the bank may render to the customers. Example include collecting and supplying the business information, acting as a referee to the financial standing of customers, etc. So now let's understand the different types of banks in India. So this classification, based on the structure of the organizational setup. So we have the different types of banks. Number one, unit bank is a type of bank under which banking operations are carried by a single branch with a single office, and they limit their operations to a specific area. Normally, unit banks may not have any branches, or it may have one or two branches. This unit banking system has its origin in the United States, and each unit bank has its own shareholders and board of management. In USA, Each state may have many unit banks, but each unit bank limits its operation within the state or the particular jurisdiction or region. There may be many central banks and they control the unit banks operating in their states. Collectively, the central banks are called Federal Reserve Banks. Another bank, another banking system that is called branch bank is a type of banking system under which the banking operations are carried with the help of branch network, and the branches are controlled by the head office of the bank through their zonal or regional offices. Each branch of a bank will be managed by a responsible person called bank branch manager, who will be assisted by officers, clerks, and sub staffs. In England and even in our country, this type of branch banking system is in practice. In India, State Bank of India is the biggest public sector bank with a very wide network of 16,000 branches. Group Bank. It is a banking system under which there will be a holding company controlling the subsidiary companies which carry out the banking business. An apt example in India is State Bank of India, which has many subsidiary banks such as State Bank of Mysore, State Bank of Travancore, State Bank of Patiala, like that. So these subsidiaries carry out the banking business and other operations such as leasing, merchant banking, and so on. Chain bank. It is a system under which different banks come under a common control through common shareholders or by the interlocking of directors. Another example in our country, we have Karur Vysya Bank, Lakshmi Vilas Bank having their head offices located in the same place like Karur and sharing common directors by which they may have common management policy. That is known as chain bank. Correspondent bank. It is a bank which link two banks of different stature or size. Many Indian banks act as a correspondent bank for many foreign banks. For example, Federal Bank has a correspondent banking arrangement with 21 international banks in different parts of the globe to deal in 13 major currencies of the world. Based on the ownership, banks have been classified. As you know, public sector banks. Public sector banks are those banks in which majority of the share, that is more than 50% of the share, it is owned by the government. The words such as the or limited will not be found in their names because the ownership of these banks are with the government and the liability is unlimited in nature. For example, in public sector, the public sector banks in India are Andhra Bank, Canara Bank, etc. Private sector banks. Private sector banks are those banks which are owned by group of private shareholders. They elect the board of directors which manages the affairs of the bank. For example, HDFC, Axis Bank, Karur Vysya Bank. So these are the examples of private sector banks. Foreign banks. Foreign banks are those banks which belong to the foreign countries and have their incorporated head office in foreign countries and bank and branch offices in other foreign countries. The share capital of these foreign banks will be fully controlled by the foreign investors. Examples of the foreign banks which are operated in our country: ABM Amro Bank, Standard Chartered Bank, JP Morgan, Chase Bank Limited, etc. Cooperative banks. Cooperative banks are those banks which are run by following cooperative principles of service motive. Their main motive is not profit making but to help the weaker sections of the society. Example: cooperative banks in India, central cooperative banks, state cooperative banks, etc. On the basis of the functions which are undertaken by the banks, banks have been classified under three heads, under different heads. Number one is savings banks. Savings banks were established just in order to encourage the savings habit among the public. There are no separate banks called savings banks, but postal department perform the functions of the savings bank. People can save even very small amount of their money in the savings banks. Okay, the amount collected from the customers is invested in safe securities like bonds, government securities, etc. Commercial banks are established in order to help carry out the trade and commerce in our country, especially for the promotion of business. They mobilize the deposit from the public and lend short-term loans to the business people in the form of overdraft, cash credit, etc. for their commercial activities. Apart from lending, they are also providing the host of other services, such as we have discussed: collection of checks, discounting bills of exchange, facilitating money transfer on behalf of the customers. These commercial banks are subject to Reserve Bank of India regulations. Industrial banks. Industrial banks were established. Industrial banks are those banks which are providing long-term loans to the industries for the purpose of expansion and modernization. They raise capital by issue of shares and debentures. So these banks are responsible for the development of the backward areas for which they promote industries in those places. The examples of industrial banks: IFCI, ICICI, IDBI. So these are some of the examples of industrial banks. As investment banks or industrial banks, they facilitate, they contribute to share capital and or take part in capital issue management or promoting the companies by underwriting their issues and facilitate the public to buy those shares. Agricultural banks. Agricultural banks are those banks which are known as land mortgage banks, as they provide the finance for agriculture sector. They provide the long-term loan facilities to the agriculture purposes, especially for the purchase of land, purchase of heavy agricultural machinery like tractors, tillers, repayment of old debts, and conservation of soil and reclamation of loans. In India, government has guaranteed the debentures issued by the agricultural banks. In Tamil Nadu, we have Tamil Nadu Cooperative Banks, Tamil Nadu Cooperative Land Development Bank. They follow the principle of cooperative banks and help the weaker sections. Cooperative banks, as we have discussed, the cooperative banks are those banks which have been registered under the Cooperative Societies Act of 1912. So these banks collect share capital from the public and lend to the economically weaker sections, especially for the members. They provide the financial assistance to the farmers, salaried class, small scale industries, etc. They can be found in rural and urban areas. and the functions are similar as commercial banks have been undertaken in lending to the rural masses. As you know, regional rural banks are those banks which were established by the Government of India under the Regional Rural Banks Act of 1976 with the specific purpose to provide the credit and other facilities to the small and marginal farmers, even agricultural laborers, artisans, and small entrepreneurs in the rural areas. Each regional rural banks operates within the specific local areas. Exchange banks are also known as the foreign exchange banks. They are incorporated outside the country but carry out the business in India. They provide the foreign exchange subject to the rules and regulations of the country in which they are being operated. They also provide the financial services, financial facilities for the exporters and a letter of credit to the importers. Example, Bank of America, Hong Kong Bank, etc. These are the examples of the foreign exchange banks. Indigenous banks. Indigenous banks are those banks, they are money lenders and sahukars. They use their own fund and deposits mobilized from public, grant loans to the needy people. They are more popular in villages and small towns. Usually they act as traders and bankers simultaneously. In our country, so these indigenous bankers can be called in different names like Marwaris, Multani. So they run indigenous banking system. Consumers banks. Consumers banks or those banks operate only in advanced countries like USA, Germany. The primary objective of these consumer banks is to provide the loans to the consumers to purchase consumer durables like car, TV, washing machine, furniture, etc. The consumers repay the loans in easy installments. Central bank. Every country has central bank. The prime responsibility of the central bank to regulate the banking system and control the monetary policy in the country. For example, in India we have Reserve Bank of India, it is the federal bank. In USA, Federal Reserve, a group of central banks. In UK, National Bank is called Bank of England. So these are the central banks which are being operated in different countries. So now let's discuss in detail about the banking sector reforms. Banking sector reforms in India were started as a follow-up measures of the economic liberalization and financial sector reforms in our country. The reforms were aimed at to make the Indian banking industry more competitive, versatile, efficient, productive, to follow international accounting standard and to free from the government's control. The reforms in the banking industry started in the early 1990s have been continued till now after the initiation of LPG programs by then the Finance Minister Dr. Manmohan Singh. There are mainly two committees have gone into the problems of commercial banking system in our country. Banking reforms were carried out with the recommendations from M. Narasimham. Narasimham Committee 1 was headed by Mr. M. Narasimham, who was the 13th Governor of RBI. This committee was appointed against the backdrop of balance of payment crisis in our country. It was set up to analyze all factors related to the financial system and give the recommendations to improve its efficiency and productively to overcome the balance of payment crisis in our country. There are two committees. Narasimham Committee 1 recommended in the year 1991, Narasimham Committee 2 in 1998. Now let us discuss the Narasimham Committee recommendations. Narasimham Committee 1 recommendations. Number 1, establishment of 4-tier hierarchy for banking structure consisting of 3 to 4 large banks with SBI at the top. The private sector banks should be treated equally with the public sector banks and no more nationalization. The ban on setting new banks in private sector should be lifted, and the licensing policy in the expansion of banking system, it has been abolished. The government has to be more liberal in the expansion of foreign banks branches in our country, and also foreign operations of Indian banks should be rationalized. SLR and CRR should be progressively brought down since from 1991 after the recommendations of the Narasimha Committee 1. The directed credit program should be re-examined, and the priority sector should be redefined to comprise small and marginal farmers and tiny industrial sectors, small business operations and weaker sections. Banking industry should follow Basel norms for capital adequacy within 3 years. That is another important recommendation. Interest rates should be deregulated to suit the market conditions. The government should tighten the prudential norms for commercial banks. The competition in lending between commercial banks should be increased, and a shift from consortium lending to the syndicated lending system has been recommended. In respect of doubtful debts, provision should be created to the extent of 100% of the security shortfall. The government share of public sector banks should be disinvested to a certain percentage, like in case of any public sector units. Each public sector bank should set up at least one rural banking subsidiary, and they should be treated at par with regional rural banks. So these are the recommendations of the Narasimham Committee 1. And now let's discuss what are the measures taken by the Government of India in the implementation of the Narasimham Committee Report 1. Lowering SLR and CRR. The high statutory liquidity ratio and cash reserve ratio reduce the profit of the banks. The statutory liquidity ratio had been reduced from 38.5 in 1991 to 25.25% in 1997. This has left more funds with the banks for allocating industry, trade and commerce, and even agriculture sector. Cash reserve ratio. Cash reserve ratio of the banks, total deposits to be maintained with the RBI. The CRR had brought down from 15%, it was in 1991, to 4.1% in June 2003. The purpose of reduction in the CRR is to release the funds which has been locked up with the RBI. Second important measure the Government of India has taken, that is prudential norms. Prudential norms have been started by RBI in order to impart professionalism in the commercial banking system. The purpose of prudential norms includes proper disclosure of the income, classification of the assets, and provisions for bad debts, so as to ensure that the books of commercial banks reflect the accurate and correct picture of financial position. Prudential norms required books to make 100% provision for all non-performing assets. Funding for this purpose was placed at rupees 10,000 crores paced over 2 years. Capital adequacy norms. Capital adequacy ratio is the ratio of minimum capital to risk asset ratio. In April 1991, RBI fixed capital adequacy norms at 8%. By March 1996, all public sector banks had attained the ratio of 8%. It was also attained even by the foreign banks which are also being operated in our country. Fourth, deregulation of interest rate. Narasimhan Committee advocated that the interest rate should be allowed to be determined by market forces, that is demand and supply. Since 1992, interest rates have become much simpler and freer. Scheduled commercial banks have now got the freedom to set the interest rates on their deposits subject to minimum floor rates and maximum ceiling rates of RBI. The interest rate on domestic terms deposits has been decontrolled. The prime lending rate of State Bank of India and other banks on general advances of over 2 lakhs has been reduced. The rate of interest on bank loans above 2 lakhs has been fully decontrolled. The interest rates on deposits and advances of all cooperative banks have been deregulated subject to minimum lending rate of 13%. Fifth measure, recovery of debt. The Government of India paused the recovery of debts due to Banks and Financial Institutions Act 1993 in order to facilitate and speed up the recovery of debts. 6 special recovery tribunals have been set up in our country. An appellate tribunal has also been set up in Mumbai in this regard. Sixth measure, competition from private sector banks. Banking is open to the private sector. New private sector banks have already started functioning. So these new private sector banks are allowed to raise the capital contribution from foreign institutional investors up to 20% and from NRIs up to 40%. So this has led the increased competition among the banks in our country to compete with the private sector banks. Access to capital market. The Banking Companies Acquisition and Transfer of Undertaking Act was amended to enable the banks to raise capital through the public issue. So this is subject to the provision that the holding of the central government would not fall below 51% of paid up capital. SBI has already raised a substantial amount of funds through the equity and bonds. Freedom of operation. Scheduled commercial banks are given freedom to operate new branches and upgrade extension counters. After attaining capital adequacy ratio and prudential accounting norms, the banks are also permitted to close non-viable branches other than in the rural areas. Sixth, local area banks. In 1996, Reserve Bank of India issued guidelines for setting up local area banks, and it gave its approval for starting up of 7 local area banks in private sector. So they will help in mobilizing the rural savings and channelizing such funds for the investment, especially in such areas. Supervision of commercial banks. Reserve Bank of India has set up a board of financial supervision with an advisory council to strengthen the supervision of the banks and financial institutions. In 1993, RBI established a new department known as Department of Supervision as an independent unit for the supervision of the commercial banks in our country. Now let's discuss in detail about the Narasimhan Committee report second, placed before the government in 1998. In order to initiate the second generation of financial sector reforms, a committee on banking sector reforms was formed in 1998 under the chairmanship of M. Narasimham. The committee submitted its report on 23rd April 1998 to the finance minister of the country. The committee focused on various areas such as capital adequacy, bank mergers, bank legislation, etc. Strengthening banks in India. The committee considered the stronger banking system in the context of the current account convertibility. It thought that Indian banks must be capable of handling problems regarding domestic liquidity and exchange rate management in the light of capital, in the light of current account convertibility. Thus, it recommended the merger of strong banks which will have multiple effects on the industrial development. Narrow banking. So those days, many public sector banks were facing problem of non-performing assets. Some of them had non-performing assets were as high as 20% of their assets. Thus, for successful rehabilitation of such banks which are facing NPAs, the committee has recommended narrow banking concept where weaker banks will be allowed to place their funds only in the short term and risk free assets. Capital adequacy ratio. In order to improve the inherent strength of the Indian banking system, the committee recommended that the government should raise the prescribed capital adequacy norms. This will further improve their absorption capacity also. Currently, the capital adequacy ratio for Indian banks is at 9%. Bank ownership. As the committee had earlier mentioned the freedom of the banks in its working and bank autonomy, it felt that the government control over the banks in the form of management and ownership and bank autonomy does not go hand in hand, and thus the second Narasimham committee has recommended a review of the functions of the boards and enabled those boards to adapt professional corporate strategy to manage the banking activities. Review of banking laws. The committee considered that there was an urgent need for reviewing and amending the main laws governing the Indian banking system, Indian banking industry, like RBI Act, Banking Regulation Act, State Bank of India Act, Bank Nationalization Act, etc. This upgradation will bring them in line with the present needs of the banking sector of the country. Apart from these recommendations, the committee has also recommended the faster computerization, technology upgradation, training of bank staff, depositizing of banks, professionalism in the banking, reviewing the bank recruitment, etc. So now let's discuss the public sector banks. The Indian banking system comprises two major sectors, as we know, public sector commercial banks and private sector. The public sector banks is controlled and managed by the government, whereas private sector bank, which is being operated by the private shareholders. So therefore, the private sector banks in India are divided into two groups. So they are old private sector banks and new private sector banks. Old private sector banks existed prior to the nationalization in 1996, 1969 and kept their independence because they were either too small or specialist to be included in nationalization. New private sector banks are those banks that have gained their banking license since the liberalization period from 1990s. So now let's discuss the distinction between public sector banks and private sector banks. Number one, the ownership of the public sector banks or the banks lies with the government. As I told you, the public sector banks which are owned and controlled and regulated by the government. Private sector banks, the ownership of the private sector banks, as I told you, it is held by the individuals and corporations as they were extended equity shares. There are 27 public sector banks at present which are being operated. There are only 21 private sector banks are being operated. The interest rate on deposits is usually high in the public sector banks, but the private sector banks, the rate of interest on deposits is marginally lower because they are competing with the public sector by reducing the rate of interest on deposits in order to attract the deposits from the public. Market share by the public sector in our country, it's around 72.9%. It is a greater share. Market share just by the private sector is just 18.7. The customer base is very high, whereas private sector is concerned, the customer base is comparatively low because customers wanted security for their fund. Of course, private sector banks are also providing the security for the customers' deposits, though the customers' base is very low. Job security is there among the people who are working in the public sector banks. Private sector banks is purely based on the performance. That means reward will be given on the basis of the performance. No pension is there. The pension is there among the employees who are working under the public sector, but the personnel or the people who are working in the private sector banks, for them no pension is allowed. So now let's have a look on the private sector banks. So now let's mention the different private sector banks which are being operated in our country. Axis Bank, Bandhan Bank, Catholic Syrian Bank, City Urban Bank, Development Credit Bank, Dhanalakshmi Bank, Federal Bank, HDFC Bank, ICICI Bank, etc. So now let's understand what are the objectives of private sector banks in our country. To dedicate our business to pursuit of social and environmental changes, to creatively balance the financial and human needs of our shareholders. Shareholders might be employees, franchisees, customers, suppliers, and shareholders. Courageously ensure that our business is economically sustainable, meeting the needs of the present without compromising the future generations. To meaningfully contribute to local, national, and international communities in which we have a trade by adopting a code of conduct which ensures care, honesty, fairness, and respect. Another important objective to passionately campaign for the protection of the environment, human and civil rights, and against animal testing within the cosmetic and toiletries industry. Another important objective to tirelessly work to narrow the gap between principles and practices, whilst making fun, passion, and care part of our daily lives. These are the objectives for which private sector banks are being operated. What are the corporate objectives of the private sector operations in our country? Increase the market share and become the market leader. Maximization of profit, of course, as other businesses which have the main objective of profit maximization. Ensure the long term growth and stability in the business. Stay a market leader through technological innovation. Diversify in order to develop new market. So these are the corporate objectives of private sector banks. So now let's understand the functions of private sector banks or functions of private sector banks in our country and the role of private sector banks in our country. Rural banking and private sector banks, commercial bank Link ICICI Bank Limited is now expanding its business to the rural banking sector. The bank is operating the small office in village to interact between the villager and banking business. The crop loan, housing loan, automobile loans, farm equipment loans, seed financing, and insurance products, which are also being offered in the rural areas by the private sector in our country. The borrowers from private sector like ICICI Bank has increased 97,000 crores today from 45,000 crores the year ended 31 March 2012, and the rural loan amount has increased to 32,000 crores today from 17,000 crores as on 31st March 2012. Thus, the private banking business in our country is to help the rural economy. Microfinancing is one of the important tools for inclusive growth. The banks like ICICI banks are trying to collaborate their services with small help groups in order to extend the credit to those groups. So this is resulting in economic growth in the rural areas. Technology adopted by the private sector banks. The new generation private sector banks are experiencing positive change in their work and performance. This change is welcomed by customers of the banks. Quick decisions and performance, paperless transactions, electronic media transactions, core banking activities are those some of the important areas in which the private sector banks are stressing. Customer relationship and private banks. The new generation private sector banks have, with a view to increasing their profitability, resorted to outsourcing of number of routine banking operations. The customers have no personal touch with the private banks. The staff control have direct relationship with the customers. The customers should get extra personalized services. This is now missing in the new generation banks. So even then there is a competition. The new generation private sector banks are showing good strengths, good growth in the banking business. Competition among private and public sector banks. The banks are presently having a stiff competition as private, public, foreign banks. The banks are now reaching to the doorsteps of the customers, and yet there is a very stiff competition that is being faced with the other banks which are also being operated side by side. Apart from various modern technologies used, the private banks are approaching for debt and credit cards wise product range suitable for customers and on their needs, infrastructure and other facilities are thus available and offered to the people. The e-banking facilities are also provided with the private sector banks, although there is phenomenal improvement that has been seen since the inception of the private sector banks in offering the services. There is abnormal growth has been achieved private sector banks in transaction cost. So now let's move on public sector banks. In India since 1970s, PSBs have been in the forefront of mobilizing these resources from far-flung rural areas as well as extending the banking services to the remotest parts of the country. The burden of social agenda has largely been shouldered by the public sector banks without any compensation. Therefore, in the interest of maintaining credibility of public sector banks, which account for nearly 70% of banking activities in our country, the government is justified in recapitalizing the public sector banks regularly. However, there is a need to undertake research on evolving appropriate norms for evaluating the performance of different public sector banks which are being operated without stiffing flow of credit to the productive sectors. So now let's understand the key functions of public sector banks. Mobilizing and pooling savings. Sorry. Financial systems mobilize savings from many diverse individuals, overcoming transaction cost and information asymmetry, and invest in projects that elicit high returns. Thereby, it enables the growth of the economy. Producing information ex ante about possible investment and allocating capital. Individuals face a high cost of acquiring information on firms, managers, market conditions, and related issues where investment opportunities exist. Financial intermediaries reduce such information cost through specialized services and economies of scale and thus improve the resource allocation. Monitoring investment and exerting corporate governance. As a provider of capital, financial intermediaries can effectively monitor and influence how firms use capital, how best they could able to utilize the resources more effectively and efficiently towards the growth of the economy. Facilitating trading, diversification and management of risk. Financial system help mitigate risks associated with individual firms and industries and countries, etc. By investing in a diversified portfolio of innovative projects, financial system also facilitate intertemporal risk sharing and smoothing over the generations, facilitating exchange of goods and services. Financial system, public sector banks facilitates the transaction in the economy by providing the mechanism to make and receive payments. The banks undertake asset transformation whereby a depositor can place resources in a bank and the bank in turn can lend to the market. Banks also perform asset liability management, focusing on gap between amount of assets subject to investment rate risk and the quantity of liability subject to such risks. The banks have also to manage risk, especially with new instruments like derivatives. The growing international dimension of the banking system has also brought in a varieties of risks like portfolio risk, credit risk, country risks, interest rate risks, and even foreign exchange risks. Management of risks has become an increasing challenge for commercial banks across the world, and hence the public sector banks the need for uniform rules and regulations in the form of Basel norms which were being operated, which were being implemented in our country. Objectives of the public sector banks helps to rapid economic growth and industrialization in the economy, creation of necessary infrastructure for the speedy economic development, to earn return on investment and thus generate the resources for the development of the economy, to promote redistribution of the income and wealth among the masses, to create employment opportunities to the people, to provide balanced regional development and promote import substitution, save and earn foreign exchange for the economy, and these act as a countervailing force and put up an effective competition to undertakings in private sector banks to gain control over and commanding heights in the economy. So these are the purposes for which public sector banks which are being operated. So now let's have a list of public sector banks: Allahabad Bank, Andhra Bank, Bank of Baroda, Bank of India, Bank of Maharashtra, Canara Bank, Central Bank of India, Corporation Bank, Dena Bank, IDBI. So these are some of the list of public sector banks and leading public sector banks in our country. List continues, and we can say Indian banks and Punjab and Sindh Bank, Syndicate Bank, Vijaya Bank. So now no more Vijaya Bank. So now it has been merged into what is called Bank of Baroda. So list of State Bank of India and its subsidiaries. List of State Bank of India and its subsidiaries as a private public sector banks. State Bank of India, State Bank of Hyderabad, State Bank of Indo, State Bank of Mysore, State Bank of Saurashtra, State Bank of Travancore, State Bank of Bikaner and Jaipur. So this is what the list of public sector banks which play the very important role. Thank you friends. Have a good day. Good night. I'll come back with another module, second module with some more banking concepts. Thank you.